Are you thinking of refinancing your mortgage in search of a better deal and paying off your mortgage early? Wait, you might get a shock when banks tell you how much penalty you need to pay just to close off your mortgage early. In this video, I'll explain you the calculations that banks use to calculate prepayment penalty, and you'll be able to use them yourself to understand how much penalty the banks will charge you. So without further ado, let's get started. In the previous video, I talked about different terms in the mortgage. And if you're new to the mortgage world, I suggest you go and check out that video before continuing here. One of the important terms is around open and closed mortgages. If you take a closed mortgage, you sign an agreement with your lender for a fixed term, which can be anywhere from 1 to 5 years. And if you want to repay your mortgage before the maturity of the term, you will end up paying a penalty to the bank. And this penalty that the banks calculate depends on many factors, which are: did you opt for a fixed or a variable rate mortgage? What's the remaining term on your mortgage? What's the current mortgage rate that banks can charge on new mortgages, as well as your outstanding principal balance? So let's look at the maths behind how banks calculate this prepayment penalty using few examples. First off, let's see how banks calculate prepayment penalty for a variable rate mortgage. In our example, Jenny has opted for a 5-year variable rate mortgage, and the interest charged to her is equal to the prime rate, which we'll assume is 7% now. She has already completed 3 years, so she's left with 2 years, and she wants to prepay the current outstanding balance of $350,000. So in this situation, prepayment penalty will be equal to 3 months worth of interest, which is calculated as principal balance, which is $350,000, times 7%, which is the interest, divided by 4. By 4, there are 4 quarters in a year, and prepayment penalty is only for 1 quarter. So the penalty comes out to be $6,125. So Jenny can pay a penalty of $6,125 on an outstanding balance of $350,000 and fully repay her loan. Next, we'll see how banks calculate prepayment penalties for a fixed rate mortgage, which is a little more complex, but don't worry, I'll walk you through step by step. We'll assume the same example, but here, instead of opting for a variable rate mortgage, Jenny opted for a fixed rate mortgage, and other conditions remain same, which is she's being charged a 7% interest, outstanding balance is $350,000, and she has already completed 3-year term. The banks will charge the prepayment penalty as higher of either a 3-month interest rate or interest rate differential, also called IRD. Let's look at this step by step. In step 1, banks will calculate a 3-month interest rate, which is same the way we calculated in the variable rate mortgage formula. So you take a principal balance, which is $350,000, multiply it by interest rate, which is 7%, divided by 4, and it comes to $6,125. In step 2, they calculate interest rate differential, IRD. To do that, they need one more variable, which is what's the current interest rate. Since Jenny is only left with 2 years in her term, so banks will look at what's the interest rate they are charging for a 2-year mortgage now. And in our example, we'll assume they can charge a 6% interest. So IRD is calculated by taking a principal balance, $350,000, multiplied by the interest rate which Jenny is paying, which is 7%, minus interest rates that banks can charge now, which is 6%, times the term left, which is 2 years. And this number comes to be $7,000. It's a little higher than a 3-month interest. So now, banks will take higher of these numbers. And we know that 7,000 is higher than 6,125. So that's the penalty they will charge Jenny. So if Jenny had opted for a fixed rate mortgage, she will pay $7,000 penalty plus the outstanding principal balance, and that way she can close off her mortgage. Now you must be wondering, why do banks use interest rate differential? Well, interest rate differential is used when the current rates in the market are lower than the rate at which they lend the money to Jenny. So if the banks try to lend the same money of $350,000 to someone else, they will actually be lending the money at a lower interest, hence losing some interest income. And to compensate themselves for that loss, they charge the penalty to Jenny. So to wrap up, you generally need to pay a penalty if you decide to close your mortgage before the maturity date. And how much you pay depends on whether you opted for a fixed rate or a variable rate mortgage. And the calculations are either a 3 months worth of interest or an interest rate differential. So it's very important that when you sign a new mortgage contract, pay special attention to these clauses. And if you're opting for a fixed rate mortgage, look carefully at how banks are going to calculate interest rate differential, because that can cost you thousands of dollars if you decide to pay off your mortgage early. When in doubt, always ask questions or seek professional help. I hope now you have all the information to calculate your prepayment penalties and decide whether refinancing still makes sense to you. For your mortgage related questions, feel free to put them in a comment box below and I'll answer them. If you like this video, give it a thumbs up. And if you really want to pay off your mortgage early without incurring any prepayment penalties, watch the video regarding accelerated payments here. I'll see you in the next video. Till then, bye-bye.